Fund manager from Emkay Investment Managers. Sachin, hi, good afternoon and welcome to Markets at Lunch. Just want to understand what is it that's, responsible for the weakness in the market, weakness in the investor sentiment right now? Is it just the elections? Is it the mixed sort of earnings that we saw in the quarter gone by, or are there more triggers which are dampening the sentiment at this point of time? And by when do you see things looking up?
Hi, thank you for your show. Very clearly the headline news at this point in time, be it geopolitical challenges, be it challenges on the global economy slowdown, be it China, US, many other challenges, right? At the same time, we have also seen the earnings not being very great. We've seen a lot of margin pressure across the companies, and in the last 2-3 months, we've also seen some bit of I would say the high frequency economic data, particularly on the Indian economy side, not supporting great, particularly the auto volumes. I think that has taken most of the investors 2 steps backward. And obviously then you have uncertainty of which is a very large event as far as the elections are concerned. So I think all of this, what really plays over the mind of the investors is that they all become a little slow in terms of incrementally allocating money to equities as an asset class. Plus, what we have also seen is the challenges on the debt side. So a lot of investors who have invested in the debt income funds and all of that, and the headlines with after ILFS, then we had 3-4 promoters getting challenges, and a lot of debt funds lending to them. So all of this does play out over the mind of investors, and therefore incrementally allocating new money to the equities is a little bit of a has slowed down, I would say. Also, you have to also see another thing. If you see the bank FD rates, the fixed deposit rates, they have actually increased by nearly 100 to 125 bips in the last, I would say, anywhere in the last 3-4 quarters. So that is also a disincentive for investors to come back to equities, because where the returns in the last 1 year, 2 years haven't been as good as even the bank FD rates. So this does discourage the new investors or people for investing in incremental money. So this does have an impact. But at the same time, what if we see in the last 1 year, a lot of stocks are down at least 30-40%, and that is where the real opportunity is. So if investors are ready to look beyond the next 3-6 months, and if the valuations are now too much on our side as an investor, so if one can really figure out some businesses where one believes that the business outlook will be fairly decent over the next 2-3 years, this is actually a very good time to selectively go and do your investing.
Right, but all stocks or all sectors that have consolidated a fair bit are not necessarily great opportunities to invest in. Some of the packs, some of the names are still quite expensive. Sachin, if you could tell us what are the kind of baskets or themes that you think are attractively valued at this point of time and that do have a good prospect going forward with respect to their financial performance?
Right. So the way we are looking at, and from the earnings season, the kind of the cues that we are seeing, or some of the movement at the ground level, and the way the businesses have evolved, and the way they have cleaned up some of their balance sheets, I think the private sector banking, and particularly on the corporate loan book side, banks which have a fairly decent exposure over there, I think some of them have now available at very reasonable valuations at this point in time, and the outlook over there also seems to be quite reasonable. At the same time, I think some of the very good quality NBFCs, because NBFCs as a overall, NBFCs and housing finance companies overall as a sector has taken a huge beating. There's been a huge derating in terms of their multiple valuations, but I think there are good quality blue chip NBFCs within the space, and some of them are now available at very reasonable valuations, and particularly the NBFCs which have exposure to the retail assets, or say even the retail rural assets, I would say, I think are fairly well positioned, and there is an opportunity there to invest. The other sector which I think one can really look at it is that where the stocks have really come off is the auto sectors. Most of the auto OEs, I'm talking about the large companies, I'm not even talking about the auto ancillaries, but the auto OEs have come off quite a bit, and whether it's two-wheelers, four-wheelers, three-wheelers, all of them, they all are today available probably in the multiples of 15 to 20x. Now, if I don't know about the next 2-3 months, markets may remain a little subdued in terms of the auto volumes not picking up. But if one does believe that India has a potential to grow from the current GDP to another 2x in the next 5, 7, 10 years, then obviously the auto as a sector, the volume growth will be in double digit. Now, if the volume growth is going to be in double digit, and if you're getting businesses today available at 15 to 20x, I definitely believe there is an opportunity over there too.
Great, Sachin. As always, it was great chatting with you and getting to know what are the stocks and the themes that you might be looking at this point of time. With that, we'll slip into a short break. But before